The following is a special edition of Commodity Week.
Todd Gleason services are made available to WILL by University of Illinois Extension.
Well, welcome to Commodity Week. I am Todd Gleason. Today's program is taken from the All Day Ag Outlook, our morning soybean panel, including Ellen Dearden from AgReview in Morton, Illinois, along with Chip Nellinger, who also is in Morton. He's with Blue Reef Agri-Marketing, and Greg Johnson of TGM. That's Total Grain Marketing in Champaign, Illinois. Commodity Week, of course, is a production of Illinois Public Media. It's public radio for the farming world, online on demand anytime you'd like to listen at willag.org. That's WILLAG.org. Now, let's go to the Beef House in Covington, Indiana on Tuesday, March the 3rd, and hear what the folks on the soybean panel had to say. I asked Ellen Dearden to lay out her thoughts first.
I'm surprised, like a lot of other folks, that the rally that came out of the mid-January lows has gone as far as it has. I see a lot of hope from Chinese business built into this market, and I'm not so sure that we're going to see Chinese business actually come about. So I'm really thinking that this is a good time period to be cleaning out of old crop beans and probably getting well along on new crop sales. I do believe that with the price of fertilizers probably and the availability given the Middle East situation, that we may end up seeing a few more beans being planted than what the report came out of the Ag Forum suggested.
Chip Nellinger, your opening statements?
Yeah, I very much agree with what Ellen said. I think, to put in perspective, a couple things hit me. Number one, if China, that's a big if they buy another 8 million metric tons, that still puts them slightly under the previous 2 years. The USDA has $1.65 billion projected for exports. You have to assume that there is already a fair amount of Chinese business in there. Yes, we're increasing the crush and the renewable diesel. That's going to be a supportive factor, but they already have increased the crush estimates as well. And so if they do buy 8 million more tons, I'm not so sure that increases the exports, because it kind of messes with the free market. You're looking at a crop size in Brazil of at least 6.5 billion bushels, maybe higher. For reference, we raise 4.2 billion bushels. So if China is forced to make a non-economic decision to buy more of our beans, I'm not sure it actually increases exports. In the end result, we're going to lose some out the back door to Brazil. And it's hard for me to believe that we won't have an effect of that massive supply for quite a while. That does not mean they can't run another 50, 60, 80 cents higher, because the funds don't sometimes factor in the fundamentals like that. But in the end, I think the massive crop in Brazil is something that's going to hang over the market for a while.
And Greg Johnson.
Well, every year we have a series of known factors and unknown factors, and throughout the course of the year, the unknowns become known. I think this year we have a lot more unknowns than what I can ever remember in a long time. And so more unknowns means more price volatility. I think we'll have a wider range of bean prices this year. Normally we have a $1.80 swing from high to low. That's the average. I think we'll see $2 plus from high to low this year. Some of the known factors is Brazil. Everybody's mentioned that. Joanna's mentioned that. Chip's mentioned that. They grow 6.5 billion bushels. Just for comparison, the U.S. is number 2 at 4.3, and Argentina's a distant third at 1.3. So Brazil is here for the long run. Here's the other thing that hasn't been mentioned. Agriculture accounts for 5.5% of the U.S. GDP. Agriculture accounts for 30% of Brazil's GDP. They are very, very committed to agriculture in Brazil. I don't see that changing. The number 2 known factor is, I think, U.S. soybean acres. Ellen hinted at this, and I agree. I think we're going to see 85 million acres of beans. That's the 5-year average. And I think with the higher input costs for corn, you're going to see 85 million acres. That's what the Ag Outlook Forum used. And if you look, historically, the Ag Outlook Forum number is very, very close to the March 31 planting acreage report. Now, it may not be anywhere close to where we end up because the government seems to change the number from March to June. And this past year, they changed it from June to October. So you never know about the planting acreage number until it's all said and done. But I think you'll see 85 million acres of beans. That's 84 million harvested. Use 53 bushels to the acre. That's a 4.45 billion bushel bean crop, 350 carry out. That's 4.8 supply. We use 4.4. So that leaves us a carry out of 400 million, assuming normal weather and assuming nothing changes on the demand side. But that's where we get into the unknowns. There's 4 big factors that are unknown, in my opinion. What's the domestic biofuel policy going to be? Supposedly, EPA submitted their RVO recommendations to the Office of Management and Budget this week. There's a 30-day comment period. Maybe we'll find something out. Maybe they'll get kicked down the road. Number 2 is energy prices. The war going on now just underlies how important crude oil prices are to soybean oil prices, which impacts soybean prices. Number 3 is China. The talks were off yesterday. That's why supposedly beans went from 20 cents higher to so many cents lower. But today the talks are back on. Tomorrow, who knows? But that China is going to be a very, very important thing to watch. And then number 4 are President Trump's policies, not just tariffs, not just with China, but all his policies. President Lincoln was called the great emancipator. President Reagan was called the great communicator. I think President Trump is the great disruptor. That's how he trades. He keeps people off balance, and that's part of his strategy. And so I think we're looking at very, very volatile markets. And so like I say that $2 swing that we could see in prices, I think we could be anywhere from $10.50 to $12.50. Where are we at today? We're at $11.30. Kind of right in the middle. So we could go $1 higher or $1 lower.
I was going to ask you what the range was. Thank you. I'm glad you put that in. I want to deal with speculation up front, which is not something I tend to do. But I think given the war in Iran, the military operation in Iran, I suppose, because it's not declared a war at this point, how will China react? Because at this point, Ellen, in the first 2 months of 2026, the United States has acted to remove leaders in 2 of China's primary crude oil partners. And I don't know how they, and I don't know that anybody knows how they will react, but I can't imagine they'll be very happy about it. What do you think that means to the marketplace?
I think it means to the marketplace that we're going to see things move around the globe in a little different manner than they have in the past. And certainly China can buy crude from Russia as well as from Venezuela, we've taken out their leader, or from other places, but not in a very expedient manner. And that's a big problem. Crude oil, watch crude prices on a daily basis and you get whiplash. Especially this week, we've seen just big moves higher. But crude oil and cattle have a very high correlation. But crude oil also has a high correlation to soybean oil. So I watch crude and I watch palm oil as good indicators on demand side of bean oil.
Chip, I want to inject in this process policy in the United States, the RVO's 45Z, the impact it has, and ask a question about the rally in soybean oil, the recent rally. So the market has a very good way of projecting what might happen. That's what it's supposed to do. So the question is the rally in soybean oil because the market believes US EPA's RVOs are going to be really good for soybeans and the movement of soybean oil into renewable diesel and biomass-based diesel of some sort? Or was it the expectation that something was going to happen in the Middle East?
No, I think it was, if you look at a soy oil chart, it was long before there was an assumption we were going to go and do something militarily in Iran. So I think primarily it has been about expectations and hopes that our domestic renewable fuels policy is going to improve in regards to soy oil demand. This week, obviously, as Ellen mentioned, high correlation, but that can only take you so far, right? A soybean crusher, it's a margin business. So as soy oil rallies and the crush margins hold together and improve, crushers are going to continue to buy beans at any level and sell meal and oil and make money doing it. But if you go however many miles it is here to Decatur, they can only be, you can't have an unlimited amount of crush capacity. There's a limit that we have. So we're going to reach that at some point. Just add on to Ellen's point, and this is, I was just scrolling through some news earlier. So Iran has stated that the Strait of Hormuz is closed, but they're going to allow Chinese vessels through. I'm not sure if Chinese vessels are going to agree to go through that flashpoint, just as a symbolic, gesture. So this thing is changing on an hour-by-hour basis. Long answer to your question. I think primarily the rally in soy oil and thus beans has been about domestic policy rather than Iran.
Ellen, you had something you want to follow up with?
I just think we're all talking about the domestic policy for biofuels, and I think we need to keep in mind, we always keep talking about vehicles that are moving on biofuels, but the big deal, I think, is really going to be the airplane fuel and maritime fuels. And we are seeing maritime fuels move quickly to use of biofuels, and that's going to be huge. Think about how much stuff moves around the globe via ship.
I want to check something I think you'll have an answer to for me, because of the Corn Growers Connection. I was on a webinar maybe 2 months ago, and if you listen, you heard parts of this related to maritime fuels and how big that might be. But it is and oddly enough, it's a methane and could be a corn-based function as opposed to a soybean-based function. Is that correct? This answer comes from Phil Sicht. He works with the Indiana Corn Growers and is a farmer from Winchester.
I was just last week, as I said earlier, Renewable Fuels Association down in Orlando. And to your point, they had a presentation on the possibility of maritime fuel, and they were, I guess, saying primarily corn ethanol, and that could be a boom. Now, conversely, LanzaJet is a company that has put together a on sustainable aviation fuel, but I think that's still in its infancy. But I think this maritime fuel business has real possibilities, and I think that was spoken to last week.
Yeah, well, one of the things that's interesting about that is that it can be that it runs through the pipelines. I did ask this question because to get it from here to the coast means the pipelines have to be able to run backwards, and not all of them do, right? Because usually it's from the coast in, and so not all of them do. So I don't know how much of a difference that'll make, but maritime fuel is something that may make a huge difference. Back to you on the RFS, the RVOs. what's crush capacity like in the United States? And is this a ethanol built-out kind of thing or something else? Meaning, I think that the RVO, probably, as we understand it at this point, is not going to increase demand for crush capacity, but will fill crush capacity to the demand to the point that we've already built it out. Is that right?
If you look at the crush numbers in the U.S., 10 years ago, we were crushing 1.8 billion bushels of beans. This year, we're crushing 2.57. That's an average increase of 70 million bushels per year. We're up 125 million from just last year. So we've, as this renewable fuels policy has encouraged U.S. producers to produce the renewable biodiesel. It also now, this supposedly, what I hear, it's discouraging Chinese used cooking oil. They're not going to get full credit. They're going to get half credit. So all of these things are encouraging more soybeans to be crushed into soybean oil. And I don't know where that ends. But it's good news so far.
That would be the half RIN or half renewable identification number. So the way that those are traded and paid out. And that's one of the things we're waiting this week to find out. So if you hear about a half RIN or not a half RIN, the other side may be, rather than a half RIN, a 1.2 or 1.6 for domestic usage. So for soybean oil, for canola oil, and for corn oil. So across the board, this side, what's happening now in policy in Washington, D.C. with the RVOs affects all of those across, and we'll know more in the next week and a half. And again, I talked to Todd Hubbs about this last week, and it's the article that the FarmDoc team, he and Scott Irwin, wrote last week as well. And it'll air this afternoon. You probably won't be in the truck for that, but you can listen to it on the podcast and try to catch up. So we're still in this process of trying to figure out, hey, do we have more domestic demand? Maybe. If we do we suppose, Ellen, that gets offset or chipped by a lack of exports? Because if we do have domestic demand and it's driven by this, there'll be a higher price internally, but it's paid out because of the government subsidy, and that might not work on our export market very well.
The U.S. has abdicated our exports of soybeans to Brazil and Argentina. I think that's pretty pure and simple. And so therefore, building these new domestic demand for beans is going to be critical. And I would add too, Todd, when you were talking about crush capacity, that there are 3 plants being built in the Dakotas as we speak, crush plants, and they are supposed to be compatible with advanced biofuels.
Yeah, I think longer term, it will help offset the lack of exports that we're going to lose to Brazil unless they have some sort of a production hiccup, and that's probably 1 out of 10 years. In the very short run, though, I'm fearful that this year and maybe next year it doesn't offset the lack of exports, and I think there's a really fair chance that the USDA is too high on their export projections. The other thing that doesn't get a lot of I didn't bring a bodyguard. I might need one after this. One thing that there's always like secondary ramifications. One thing that doesn't get a lot of talk right now, all this domestic crush, 18% of the crush is soy oil, 42% is soy meal. What do we get? I know meal exports have increased. What are we going to do with all the meal? It's going to compete with DDGs. It's going to be potentially a direct competitor to corn. No one's talking about that a lot. And so we're going to have to deal with that eventually, or find an export market to ramp up fast on our meal.
Have you got questions out here? I know you do. Just raise your hand and I'll bring the mic out to you. So let's talk about that just a little bit. And because the meal needs to be offset. It's probably that whole crush thing may be a deeper discussion than is necessary here. But looking forward, maybe we can start with old crop beans. If they have anything left, do they sell them today or soon?
Old crop beans, I think farmers are pretty much 80% sold. In our trade territory and other elevators I've talked to, farmers have done a good job of selling beans because there's been opportunities to sell beans at what I would call good prices. So you're holding on to that last 10, 15, 20% for gambling stocks. I think there's just as good a chance of them going up as going down in the short run. Again, keep reading the farmdoc articles to find out how this RVO is going to play out, how everything else is going to play out. I will change my opinion when the facts on the ground change, and the facts are changing all the time. But as far as selling old crop beans, I think farmers have done a good job. They really don't need to sell anymore at this point if you're 80% sold. New crop beans, Todd, we've talked about since October, November. I wanted to sell $11 cash beans, which is $11.30 November futures, because we've got a 30-cent basis. And that's where we're at today. We're still paying $11. I think you should have 20% sold there. And you heard me say that they could go to $12.50, but you heard me say they could go to $10.50. So we're right in the middle there at $11.50-ish. So why not sell some? I'm not trying to predict the price. I'm saying, again, I'm going to lean on FarmDoc. FarmDoc says we can make $25 an acre at these prices in soybeans. We're losing money growing corn at these prices. So I'm going to lock in a profit and sell some beans.
Ellen Dearden?
Old crop beans I want to be done with, and I think that the Central Corn Belt farmer has done a very good job and probably is 80%, maybe 85% sold on old beans. But the further west you go, the more beans there are yet to market, and I've really been pushing subscribers of mine in that area to get moving. Transportation situation from here going west is pretty difficult on the bean side, so it's the crushers that are driving the market. Basis is not as good as it is here. New crop basis is far wider than 30 cents, even in our area in Morton, Illinois. But there's a lot of 50, 60, 70, 80 under basis for new crop. And not very many guys that I talk to in the Dakotas are all that excited about selling 1050 beans at this stage of the game. They'll do a little more waiting and seeing. I'm really trying to encourage people to do some selling on these new crop beans as well.
So what are you thinking about soybean sales?
Yeah, I mean, we'd be out of old beans right now. If you want to play that China's going to save us, do it with call spreads. We would be 20 to 25% priced on new beans, with another 20 to 30% with some sort of put coverage. My philosophy is this, especially for farmers in this room, in this area, this type of dirt. If you can make a little money on beans right now, be more aggressive on new beans. If you're $1 early, guess what? You're going to make more money net because you raise 4 times as many bushels of corn as you do beans. And if beans rally $1, especially if it's in the next 70, 80 days, we're going to lose more corn acres. You're going to backdoor into a big corn rally. $5 D's corn makes you a lot more money than $12.50 November beans. So we want to be more aggressive on beans. I would be even a little more, and I'm talking like next fall in the most bearish scenario. I'm not sure that 1050 would catch it on the downside. I think you could push November beans into the 9s very easily in the worst case scenario.
With the soybean market as it is, because you mentioned China not betting on it, I do want to bet on it. What's the percentage that China saves the day?
That they're going to buy?
Yeah. You think there's a 20% chance they'll buy what they've said?
It's strictly a political move. If President Xi has gotten rid of a lot of his generals, 6 big generals left, does he have a solid support from his citizenry? If He needs more support from the citizens, i.e. the next round of generals that came in. He will try to cozy up to the U.S., and the easy way to cozy up to the U.S. that I see right now is through policy, and part of the policy would include ag products.
Anybody else?
I would just gun to my head, 35% chance. It's going to cost them $300 to $400 million extra dollars to buy our beans versus Brazil, but it might benefit them by $1 trillion to have access to other products importing into the United States. But it's it messes up supply and demand in normal markets. So you still have a massive supply of beans in the southern hemisphere that we've got to deal with.
Yeah, the tariffs that we put on Chinese products that come here are in the trillions. What if they buy extra beans, we're talking billions. So yeah, they could lose money. It's uneconomic for them to buy those soybeans from the U.S. They can buy them 80 cents a bushel cheaper out of Brazil right now. But they might look at the big picture and say, okay, we're spending a little bit more money on these soybeans from the U.S., but in return, we're getting our products over into the U.S. at reduced tariff rates.
Other questions? Go ahead. Yell it out from the back. Yes, please.
Iran war, that is part of the China-Russia complex of the communist and socialist parties. Somebody mentioned Venezuela. That's not going to happen because we've already embargoed all the oil. So they won't be pulling much there. We've already shot down a couple of ships going to China. So I just suggest this is the year to stay awake if you're in agriculture. Thank you.
I think it ties right into there's more uncertainties out there than there are certainties. I think this is, and I'm going to change my mind 3 months, 4 months from now, Todd, when we're on the air. But right now, I like being 20% sold with another offer in to sell another 20% if we go 50 cents higher. And again, I'm not predicting that those are the high prices. I'm just saying those are profitable prices. And I don't know how else to do it other than lock in profits when the market gives you a chance. Because remember the January 12th crop report. We had a lot of doom and gloom for the next 30 days. And that can happen again. I mean, when the prices go low, they tend to stay low until something happens. And hopefully we'll have a weather supply problem or we'll have some demand-driven rallies. But we need to take advantage of those when they happen.
Just for clarification's sake, see, your argument there was that you need to be vigilant, but you're worried that China's just going to be out of the marketplace. Is that right?
These are my opinions. I would highly suggest that China's not going to be a major player in the U.S. market with our tariff programs going on, with the war in Iran still going on. I think there's going to be a lot for them to be allies of their BRIC partners and utilize them. They got to keep that coalition together. They got to have food security and they got to have grain. So there's no difference. I think there's one given in this whole situation is you got a crop insurance plan that basically 80% premiums are subsidized. And you can use them just as well as the CBOT to do some really good marketing. Thank you.
So BRIC, Brazil, Russia, India, China. So he just says, hey, China's going to deal with the BRIC countries because they're trying to figure that out. They're also trying to figure out if they can do their own currency together. Nobody believes that will happen, I don't think, because there are just too many competing industries or competing things happening there. So just a quick final word from each of you at this point. We'll start with you, Chip. Chip Nellinger is with Blue Reef Agri-Marketing.
Yeah, we talk about uncertainty a lot, and we will this afternoon, I'm sure, as well. Have a plan, right? If you don't have a plan, we've seen a lot of volatility, and you need volatility to have opportunity, but you need a plan to take advantage of the opportunity. Have offers working. We see the last 2 days, right? We're 20 higher in the overnight. By 10 o'clock in the morning, you're 5 lower in beans. If you don't have offers in, they're not going to get filled potentially. So you got to have a plan of attack. Have a plan. Execute on it. Don't cancel if close. Don't put the old cancel if close order in, and look at profitability. That plan needs to really zero in on the costs. I'm sure you're going to talk about it in the corn panel. One thing I learned this week and I've been in the business a long time, about a third of the nitrogen moves through the stream. Everyone knows that how much oil moves through there. Third of the nitrogen. Urea prices are up 20% at the Gulf this week, and it's Tuesday. So uncertainty, but you got to have a plan to take advantage of it.
Wait till Thursday. Ellen Dearden from AgReview, your final thoughts.
I think that this is a year to have a market buddy, maybe. Somebody that you can talk markets with, and it may not be somebody in your neighborhood. And I think that there's a lot of opportunities once you look outside your neighborhood to find somebody who will urge you to make sales or to remind you that not everything looks like Central Illinois or Central Indiana. Keep offers in.
And finally, Greg Johnson with TGM.
I would just echo what Chip and Ellen said. You have to have a marketing plan. If you don't have it written down, it's not really a plan. You can change it. I'm going to change mine, but I've got it written down. I want to sell 40% of my beans sooner rather than later. I've already got 20% sold. And I want to have another 20% sold. Now that could change based on what happens, but you have to have beans sold. And if I have 40% sold and they go higher, guess what? I've still got 60% of my beans left to sell at a higher price. At the money calls are well over 50 cents. So just buying a call to protect a sale isn't going to work. But as Chip said, you can do vertical bull call spreads where you buy a $12 call and sell a $13 call, for example. You can do things like that to cheapen the cost of that insurance. The other thing we haven't really talked about, people say, well, yeah, I can make money at $11.50, but it's not sexy. It's just kind of so-so. Keep in mind, you're going to get 75 cents from the government between the bridge payment and the Ark County payment. So you can add, I like to justify, $11.25 sales by saying, add 75 cents of that. There's your $12 beans. So if you can get 75 cents from the government and $11.25 from the market, there's $12 beans. Don't forget about that government money.
This edition of Commodity Week was recorded Tuesday, March 3rd during the All-Day Ag Outlook at the Beef House in Covington, Indiana. Our panelists for the day included Chip Nellinger of Blue Reef Agri-Marketing, Greg Johnson from TGM, and Ellen Dearden of AgReview. I'm University of Illinois Extension's Todd Gleason.